How's it going, guys? Welcome to the Capital Mindset Show. We're your hosts, Austin and Fabio, and today we're doing the What Are You Buying or Have Bought today, Fabio. And actually, we're covering a stock, Multi-Source Portfolio Solutions. And Fabio, I want you to kind of walk us through a little bit your initial cost basis, what your projections were coming into this, and then also what you've gotten out of it since.
Yeah, so this is a business that I was initially acquiring around $7, and I continue to add all the way through $8. And I think I have some in my retirement account for even like the low $9. And basically, Altisource is a business that operates as an integrated service provider. It works in real estate, mortgage industries in the United States. And it's actually headquartered in Luxembourg, so it's not even an American business. So what you can kind of understand a little bit about them is they have some SaaS platforms underneath their portfolio, but they make a lot of their revenue from foreclosure services. So basically, you can kind of think of this, to put it simply, is that they generate income off of mortgages that go bad and undergo foreclosure. So basically in that they offer the SaaS platform that helps lenders kind of recover their lost capital. So they operate within that industry as kind of like a helper of sorts. They're not directly the guy taking your house when you get foreclosed on. That would be the bank or whoever your mortgage provider is, but they are the ones that facilitate that transaction. And essentially, I think what you were going to ask, right, is why I bought.
And then also what your cost basis was too.
Yeah, so my cost basis varies. I'd have to calculate that, but I'll post it right here, all the different accounts. I mean, I'll post the ones I own on my Charles Schwab account and my Merrill account here. I won't post the ones my wife owns, but I'll post those ones. You can add them all up. I know it's well over 1,000, even 2,000 shares. And just to be very clear before we continue through this video, this is a very speculative position. It makes up, I think, a total of around initially 1.6. I put a limit on what I could put in at 1.6% of the portfolio. No more than that. And it's grown past that. I'm not going to sell any just yet. We'll get into that actually later, but no one can replicate this trade. I wouldn't want anyone to replicate this trade because you have to look at it yourself and to what risk you can take. So you can't just see a guy on the internet and then just say, oh, that person's doing it, must be a great idea. Never do that. So in that case, if you take a look at the numbers and you personally believe that for your own sake, you think it's okay, well, that's your decision. For me, I bought it when I did, and that is something that is currently not something that can be replicated.
Yeah, perfect. So then would you also kind of, in fact, pull open the model itself? Because I remember when I was taking a look at the stock too, it was negative in pretty much everything. So I would like to see what our discounted cash flow model has in store for us, Fabio.
Yeah, so I'll go ahead and share the model right now. So it'll pop up right here. And let's go ahead and put in the ticker. That's ASPS. And we gotta give a required rate of return. So I'll start out with the standard. Let's do a 15% because it is on the speculative side. Unlike a previous video we made, there's no acquisition going on here. Let's see if they've been doing any. Well, actually, for now, let's assume no buybacks. And let's take some growth rates of between 5% to 10%.
Let's also put a 2% growth rate in there too, Fabio.
Okay, actually, let's do 10, and I'll actually replace the 7 with a 2. Get an idea. Okay, so under the assumption of no buybacks at a 15% discount rate, this is what we're looking at. And I believe I've already put the non-profitable assumption of 7%. And let me explain why it is. Because last year in 2020, the main moneymaker for this business was essentially illegal with the mortgage moratorium. And a huge part of the thesis was the end to the mortgage moratorium. I looked at this as a speculative insurance bet on the market. So should there be a strange spike in foreclosures, this company would stand to benefit, and so would my position. So I took what they normally perform on an average year as far as cash flows relative to revenues, and then I extrapolated that and put that in for the 7%. So pretty basic measure there. And what we're going to see is, so assuming normal operations, what we're going to see there is at those assumptions, if we take a look at the growth rates that we can project from there, I would not need that much growth on a cash flow basis in order to get a required rate of return of about 15%. Now, what is interesting is I created this little test thing here to kind of see how long it would take for them to recover. And just so everyone knows, they've had about 600 million in revenues before COVID. So if I take a look at this, I believe the required return, sorry, not the required return, the percent here is 9%. So at a 9%, if we look at a 10-year model, that's about where I would assume a recovery, not an improvement, just a recovery. So we just assume it takes them 10 years to get there, or 9 years to get there. And I take I'd say an 8% because I'm removing that final year. Let's actually change that to a 9 just to see. There we go. Now it's accounted for. So in 9 years, and let's change this 5% to a 9%, we get our price to buy. If my required rate of return is 12%, again, assuming that they get to normalized operations of 7%. Now, if I increase that because I believe the risk is a little bit greater, I need to pay greater premium. So at 20%, these are my buy prices, and you've noticed that it's actually below my average cost. So as it is below my average cost, this is kind of what I was looking at back then when I decided to make this investment. And then also I had the tailwinds of the ending of the mortgage moratorium. So I didn't believe actually it would just recover. I do believe that it actually could surpass that. And in which case we can actually test or take a look at what it would be like if, let's say, it recovers quicker. All right, just to get an idea of a faster recovery. And let's scroll that down. So we see on the 5th year, we get a full recovery. So let's change this model out to a 5-year. And let's put one of these at 25%, which is the assumption of a recovery. Well, at an assumption of a recovery within 5 years, that's assuming, quicker growth rate to that recovery, I get around $12.37 as my buy price for a required rate of return of 20%. Again, let's assume a little bit greater risk there. So it's still within my required rate of return at around my average cost. Again, like I said, my trade cannot be replicated. This video is just for entertainment purposes. Exactly. Yeah. Entertainment purposes. What's interesting about this business actually is that they have averaged out some buybacks.
That is interesting.
Yeah, very interesting. And we'll take a look at the ratios real quick to kind of explain that. But if I assume a 2% buyback over the next 5 years, it does improve it quite a bit, just a little bit. You can see the numbers go down. Remember that the 25% discount was a little too aggressive. But at a 2% buyback assumption, at a 20% required rate of return, it does nudge these buy prices up a little bit. So I'll go ahead and change it again for those who missed it. So that's a no. Then that's back to a yes. All right, so real quick, let's take a look at the key ratios. Kind of get an idea of what this business has been doing. And we can see deterioration here, deterioration here, deterioration here, deterioration here, here. Everything's getting worse. So lots of red flags everywhere. However, you got to look at the nuance. So investing isn't just about looking at the past and extrapolating into the future. While you want to see improvements over time, you have to be understanding of the context. Do you have any questions, Austin, about what we're looking at here?
This is kind of a joke, Fabio, but are these profit margins what we would like to see in an industry like this?
No,
Yeah.
not at all. Very much, we would not like to see negative operating margins. But
yeah,
if we look at
I
the
figured.
context, yeah, it's normal. All right, so then these are kind of applicable. So these are bad, to say the least. Earnings quality is essentially saying that the net income or the GAAP net income for these years tended to be greater than that of the free cash flow. And I guess it could be because of the way they're recognizing GAAP. And also when it's negative, it does mess with the calculation a little bit. So for example, here, the free cash flow is actually better. So this should be in context a positive. But when it's negative, it does mess with the calculator. And then here again, so actually, when you look down in the numbers, these are better than the GAAP net income margins. So over here, there's something going on with like a recognition. If we actually were to look back there, it could be anything that's causing the GAAP net income, but we see that free cash flows, pretty stable, declining slightly. They had a great year over here in 2018.
So
book value.
Fabio, I actually kind of have a question. So they were actually, or your model was saying there's been around a 2% buyback. Yeah, I'm seeing here in their free cash flow that's negative. How are they funding these buybacks?
That's actually a great question. So a lot of the negative cash flows were attributable to 2020 and 2021. We all know what happened there. And basically their business was made illegal for that time period. So I would expect to see negative cash flows. But however, for most of the time that we're measuring in this period, the free cash flow was actually positive and the business was actually yielding a healthy amount of cash. So they were probably able to fund buybacks, not with debt, but with free cash flow. And the way we can find that out is if we go take a look at the long-term debt, and we can take a look at that at the sheet over here where I have their long-term debt right over here, and we get to see that it's actually been declining over time. And Austin, would you like to make a comment here with your accounting background?
So basically then, if I'm seeing the long-term debt declining over time, then going back to the key ratios, why am I seeing those solvency ratios increasing? So for example, total debt ratio and long-term debt ratio, why am I seeing these numbers increasing, Fabio?
So that actually must mean that the total assets must be decreasing as well, and potentially at a faster rate. And actually, we can see that here. So even though the long-term debt is decreasing, total assets are also decreasing at a faster rate, thus leading to a deterioration of this measurement in the key ratios. So that could mean anything. They're selling off some assets, they're becoming more asset-light business, and they're just getting rid of that debt. They're becoming a debt-lighter business, So nothing to be too concerned of, but it is nice to know that the share count's going down and debt is going down, because the number one reason businesses go bankrupt is debt. Okay, so the next set of ratios aren't really applicable, so we won't spend too much time here, and that's because they're not an inventory business. So that's it. So in summary, what we're looking at here is a speculative investment. Okay, a highly speculative investment, nothing more, never going to be a core position, and something where if you believe that there is a recovery in this industry, that it may or may not present an interesting opportunity depending on the price one is comfortable paying. And everything on returns is dependent on the price someone pays for something, just like any other asset. At the point in which time when I acquired the business, I was very comfortable with the price and the prospects of recovery. I did believe that there could have been something not as severe, but similar to the great financial crisis, and that it would act as insurance within my portfolio should that occur. I will put a screenshot right now of the stock price during that time, and how it behaved. If anything similar were to occur to the underlying business as it did back then, that would be a great boost to the portfolio, where in which I could sell out and redeploy that capital into more core holdings within the portfolio.
Mm-hmm.
Would you have anything other to add, Austin?
Nope, that's been it. And if you guys have liked what you've seen here today, be sure to like, comment, and subscribe. Or if you have any questions about the material that you've seen here today, we will be responding to any and all comments. And we urge you to visit our website, capitalmindset.org. And we're your hosts, Austin and Fabio, and we'll see you guys next time. Take care.